What if I told you you could escape the rat race, as they call it, the rat race, that everyone knows about? You work 9 to 5 for the rest of your life pretty much until you retire, and then you get to enjoy your life when you're 65, statistically. You could change that by the power of compound interest. So let's dive into that. I'm just going to show you a comparison, or what could be if you did follow these steps, and it could show you maybe something that could be a possibility for you to do, maybe. Everyone's circumstances are different to others. So the graph I'm showing on screen now is a graph showing you what could be achieved at 7% annual interest rate. And to achieve the first $1 million, and we're going to just make it as pounds because I'm from England, so it just makes it easier. Obviously, if you're American, you're watching it from America, just say it's dollars, but let's just say it's pounds. As it's saying right now, it's saying that you will do an annual savings of £10,000 a year. That might be achievable for some people it might not be. Some people might be able to do more than that. But let's just go off the basis of £10,000 a year of savings, which is about £833 a month, I believe. But just to make it easier, we'll do £10,000 a year, and that's an annual conservative rate of 7%, because the S&P 500 as an ETF, which is the top 500 companies in America, it can average between 7 to 10%. I think on average, I believe it is like 8-9%. But let's just go more conservative of the 7% annual interest rate. What you'll be doing is putting in 78% of your money, of the 100k, will be from your savings. So the amount of money you're putting every month, 78% of that will be to get to your first 100k, which will take about just under 8 years, which seems a long time. I know in a minute we're going to go on to something that can maybe achieve this quicker, but let's just get on to and stick to this first. So to achieve your first 100k, it'll take about just under 8 years, with returns, with most of that coming from your savings, like we said, and then the rest will be the returns, the interest that you've accumulated over the years from, let's say, the S&P 500. The next 100k would take about 5 years, and half of it will be savings pretty much, and half of it will be returns. So you see the big difference already. And then it goes to 3.7 years for another 100k. And then, as you can see, once you get to like the 500k mark, it takes about 2 years to get to the next 100k from 600. And obviously it just gets quicker and quicker very, very rapidly. If you are watching this and you're older and you're thinking, well, I don't have that amount of time to get to $1 million because it's going to take up 20 years of my life, 25 years of my life, there's other options that you can do, which is what I want to talk about. It just depends on people's risk tolerances and also financial situation, because you could do the opposite. You could do the opposite and go and do 20k a year in savings. I know that's a lot of money, so not everyone will be able to do that. But if you were in the financial position to do that, then obviously it will help the timings of that, and be able to reduce down the amount of years you'll be in the stock market to get that £1 million. So it's about just over 30 years in total to achieve that $1 million, starting from zero as it stands right today. If you started it today and you did 10,000 a year, to reach $1 million would take you about 30 years. So obviously, when I'm saying when you're 18, you'll be 48, which would be amazing to be a millionaire at 48. Obviously, inflation encounters with this, so you would probably be putting more away each year. So instead of 10,000, it will probably, well, as inflation goes up, obviously your wages will go up, so you'll probably be doing more like 15,000 a year eventually at some points, and then vice versa. Do you know what I mean? But anyway, we're gonna not try and complicate things. It will take you about 30 years. So if you wanted to obviously get it down quicker, then let's do the compound calculator. So you're starting off with zero, nothing. You're starting off with zero, but this time the interest rate is 14%. And the reason why I've done 14% is, yes, it's a lot, but also in the grand scheme of things, if you want to put some time and effort into the stock market and research more, I think 14% is achievable. a year. This is by going with undervalued stocks, buying stocks that are undervalued, stocks that got a lot of growth opportunities. But obviously this comes down with more risk because you're going off your opinions, you're going off your research. So and you're also putting some time and effort into trying to find those. This is something I personally do. I get into individual stocks, as you'll see on my portfolio update videos that I do pretty much every month at least, or sometimes 2 times a month. So you'll be able to see the stocks that I pick. But let's say 14% on average a year, and you were to do it for the 30 years that that graph shows, 30 years, and you were putting in £833 a month. So that would be a future of £4.5 million. So obviously a massive jump, a massive difference by just doubling up the amount of interest that you are doing a year. And obviously that is by going off stock picks. So for example, PayPal that I got into last year, I'm up 60% on that. Granted, that's not always going to happen, so you want to counter and average it all out. You're going to have some losers, you're going to have some ones that don't perform as well. So for instance, obviously Palantir, I've gone up 200-300%, but that is a bloody rarity. That is not normal. That's just, yeah. Tesla 100%, so far 100%. So these are the type of stocks I've been doing, but obviously that's not going to happen every year. There's going to be some years that aren't going to be like that at all. And like I said, you're relying on yourself and trying to find the value and working out when it's time to sell, etc. You only want to be in the stock market for 15 years because you don't have a lot of time on your side. Well, you're looking at $500,000. So it's still decent. It's still like, just by getting the better returns, you can just the power of compounding and compound interest, and that's going off £833 a month. So if you can put in more money, then yeah. And obviously that's starting off with an initial investment of zero. Some of you might be already been in the stock market. So my portfolio at the moment is 70,000. So if I was to get a 14% interest rate and I was putting £833 a month in for 15 years, I'm projected to have $1 million. The reason why I've made this video is because at the moment interest rates, well, they're actually high. They're about, you can, if you're lucky, you can get interest account for about 4 or 5%, which is good considering most of the time it has been about 1-2% in the past. So 5%, 4% is good. However, inflation is just under 3%. And at the moment, you're beating inflation with the banks by having your money in the banks and you're earning interest. So you're beating inflation by just about. And the problem is with this is I believe we're not going to have interest rates like that for the next 10 years, next 5-10 years, let alone 15 years or whatever it's going to be. If you choose to do the way of putting money in the stock market, let's say you do go down the route of just being a saver, like the, I guess, traditional way. You save and you're putting your money away in a savings account and you're getting interest with 5%, 4%. You're beating inflation by 1% or 2%. And it's like, but then what happens when the interest rates go down again and if you're lucky, getting 2%, 3% in your savings? That becomes an issue because you're just matching inflation. If not, inflation is beating you. So technically you could see it as like you've got that £1,000 in the bank and someone's taking money away from you and it's now £900. Obviously that's not going to happen because the figures, that just won't happen. But technically that's kind of what's essentially happening. You'll be having money in your bank account and it's eroding away without you kind of realizing. And that's kind of a big problem, to be honest with you. And that's why you want to be trying to beat inflation all the time and also just trying to maximize as much gains as you can, because I know between me and you, you're probably not going to want to be working all your life. If possible, you want to try and be able to enjoy your life the younger you can. Like, why not? Because that's what life's about. Like, you want to enjoy as much as you can, if you can, obviously, if you're in that position too. So yeah, that is why I personally like to try and pick my own stocks, because I want to try and then go. So I guess you could say you've got different levels to things. You've got your interest rates because you want to try and beat inflation. So you're trying to level up and beat the inflation rate. So by putting it in a high interest rate by 5%, or putting it in bonds, or whatever you want to do. And then you want to try and beat that because you want a bit more interest. So you know that the stock market historically with the S&P 500 can get you 8 to 9% a year. Then you go into that. And then there's people that obviously want to have more and try and beat the S&P 500 and have more interest. So then they start going into individual stocks and buying individual stocks. And obviously that comes with a lot more risk because you are literally doing it yourself, and you are trying to find value in those stocks. But then you also get the opportunity to sometimes make gains in a year where you do 100%, because that's what some people have done. I've personally done that this year, which is something that's been amazing. Obviously that's because of a certain stock that I hold, and I am prepared for it to half. I am prepared for that price to half, but I've still doubled my money from that stock alone, even if it did half. So yeah, you could buy individual stocks and try and grow your money that way. You would just have to do more research yourself, and it's on you to get it right. But if you want peace of mind and you just want the S&P 500 where it's the top 500 companies, they get rid of the bad ones and then they put in the good ones. So it's always recycling whatever's the best 500 companies at the time. So if you want that peace of mind and not have to worry about it, then I would recommend just getting into the S&P 500. And another little tip that I think could be something that you might want to think about is, obviously there's corrections and crashes in the stock market. So if you're putting £1,000 a month in and there's a correction or a crash, that month where you're meant to put £1,000 in, if you can and have the money, I would double down and do £2,000 a month, or just anything more you can possibly do, because corrections and crashes is a buying opportunity. So historically, if you enjoyed this video, hit the thumbs up, subscribe if you're new, and check out my portfolio update videos.